Good morning and welcome this morning to Trading Futures, another great webcast from Schwab Coaching. There was the opening bell. That means that the cash market's off and running, and that means that we're up and talking about trading futures. Welcome to all of you. Welcome to my good friend Michael Fairborn out there in the chat, helping to answer your questions. And he's the one that's been filling in for me while I've been out on the road and teaching and taking some vacation time. So I'm back here. Let's jump into this discussion this morning. We're going to talk a little bit about some of the things that are moving, namely gold and copper in the metals space. But I also want to talk about, and this is based on a request that you have made in the last few weeks, about the idea of an intra-market, meaning within the same market, spread trade, sometimes referred to as a futures calendar spread. Now, not to be confused with a calendar spread using options or options on futures, but two different expirations of futures contracts. And we'll talk about that as we get into this discussion this morning. A couple of quick reminders, though, and housekeeping items that we do need to take care of. First of all, remember that futures and futures options trading involves substantial risk. It is not suitable for all investors. I'm going to say that again. It involves substantial risk. It is not suitable for all investors. Make sure that you read the risk disclosure statement for futures and options prior to even considering trading any futures products. Remember, the futures options or futures accounts are not protected by the SIPC. Futures margin is the amount of money you're required to deposit or have in your futures account to establish and maintain a futures position. We'll talk about some of those circumstances today as we get into this discussion. Also, remember that everything we talk about simply for illustrative and educational purposes only. It's not a recommendation of any kind or an endorsement of any particular account or account strategy or account idea. Remember specifically that virtual currency derivatives, including those that talk about Bitcoin and Ethereum and others, contain unique and significant risks. So be aware of that. We may talk about those today. They have been moving a little bit. So we'll maybe look at those as we get into this discussion. But make sure that you read the NFA Investor Advisory and the CFTC Customer Advisory on those products specifically. You understand that those are digital representations of value, that they don't, they may function as a medium of exchange, but they don't have legal tender status. The derivatives on those products contain specific risks and risks that are associated with that status of those crypto or virtual derivatives. So we'll talk more about that as we get into this discussion. We're going to be using the Thinkorswim desktop software platform, specifically the Paper Money platform today. Not a guarantee of future success out there in the real world, but a good learning environment. Make sure that you understand that some things are different in a live trading account than in a paper money account. And as you move your practice from paper trading to live trading, make sure that you're aware that there will be some differences. Now, we're going to use some technical analysis in this discussion. It is not a guarantee of future success. It's not a guarantee of market movement. Neither is probability analysis or fundamental analysis for that matter. Schwab doesn't recommend the use of technical analysis as a sole means of investment research. And investing involves risk, including for some products like futures contracts, more than your initial investment in the trade. And again, I want to make sure that we're clear about this. I know somebody made the comment about this out there in the comments section. That why do we need to review this every single time? But this is important enough to make this review. Stop orders do not guarantee an execution in futures contracts. Due to exchange-based rules, certain conditions at the time of activation, because that's what we can specify, the exchange may reject or substitute an exchange-designated limit order for the originally triggered market order. Now, generally for trading equities or equity options, we put out a stop market order. Barring certain circumstances, those orders are going to get filled at whatever price. But with futures contracts, because the exchange works that exchange designated limit order, there is the potential that the order does not get filled and it gaps around, or it is rejected by the exchange. So just be aware of that difference between trading futures and using stops versus trading equities and equity options using stops. It's an important distinction between those. So let's, as we get into this, we'll talk a little bit more about that as well. So let's jump in here really quickly. I'm going to pop over here to the Thinkorswim desktop software platform. And I had a trade that I was looking at early this morning and had specified and actually ended up getting into this trade. And this is on the 1 ounce futures contract. And you can kind of see what it had been doing over the last few days, kind of bouncing to the downside here off of this resistance around the 42.75 mark. Starting to push back down to the downside here a little bit. And in this particular case, looking for that move below this support level. And that's kind of where I had placed my entry into the trade. This was a sell stop. And that sell stop coming on the break of that support level to the downside. The intent was to have this continue to move to the downside. Now, here's the difference in terms of what ended up occurring in this particular circumstance is that we got filled on the trade as it broke below this level of support. That was our trigger at 42.19 to get into the trade to the downside, selling the contract, going short this 1 ounce futures contract. And I had, in creating the order, put a stop up here around 42.31. And in fact, what exactly happened was exactly what that stop order is designed to potentially address. And that is if, in fact, we get a bounce in the opposite direction and it moves against us quickly. And in fact, it did. And it moved above and triggered us back out of the trade. So we go back over here to the monitor tab, and we can see that in that futures contract, we got into that trade and we got out of that trade pretty quickly. And you can see where that is now. It's back moving in the direction that we wanted it to go. So that's the scenario that can happen. And so when this is 1 ounce gold contract, this is the 1 ounce gold contract. So when I talk about the fact that, you know, when we look at risk in futures trades, and we talk about, you know, trying to manage that risk, or at least defining somewhat where those levels are that we would take the trade off, there is a real possibility that a trade can go against you, against a trader quickly, as this one did, because it popped down here below that support level and filled, and then ran immediately in the next two candles, those next two 5-minute candles, just while we were sitting there talking, and triggered us back out off the stop. But that's why that's there. And again, that was a stop that got worked as an exchange designated limit order. So I think there's still some bearishness here, just from the trend, because it popped up above that support level and moved back down. So, you know, sometimes, you know, when you hit yourself in the head with a ball peen hammer, it stops hurting when you stop doing it. But when you're doing it, maybe it doesn't hurt so bad. So what I'm going to do is I'm going to look at going back into this trade with that potential same expectation. I don't know that the expectation here from a trend perspective has really changed. I think, in fact, it's kind of redefined where those levels are. This is a level of support. There's some buying pressure there. And if it can break through that support. So what I'm going to do is I'm going to alter my original plan on this particular trade just a little bit. I'm going to look at entering down here at 42.18. So giving it a little bit more move to the downside, not just right off of that support level. So actually some movement through that area where perhaps there was some buying pressure to get into the trade, and still targeting down here at 42.01 as the take profit exit on this trade, and still looking at the stop back up here at 42.31. So let's do that. I'm going to right click on this trade. And actually what I'm going to do is I'm going to do sell custom with OCO bracket. And we'll walk through this process once again. And again, remember, it's always a good idea to walk through this slowly, make sure that you understand what it is that you're trading and what it is that you're trying to accomplish with this particular trade. So we're going to do that here really quickly. So I want to get in if the price of this futures contract goes below 42.18. So I'm going to make this entry price, this entry order line. So this is a sell custom with OCO bracket, a sell at 42.18. Now, in order to get this to sell at 42.18 or thereabouts, what I have to do is change that from a limit order, because if I were to do it right now as a limit order, and this is a common mistake, is just leaving that sell order as a limit order, because that would say sell it right now. But I don't want to sell it right now because I have no guarantee or no confidence based on this, and I'd never have a guarantee. But I have no confidence that the price is going to go through this level of support to the downside. So I want to do that. I want to enter the trade when it's done that already, when I have evidence of that. So I'm going to make this a sell stop by just making that a stop order. Now this is a sell stop market. Now remember, a market order is going to get worked as an exchange designated limit order. So if this moves through 42.18, then it's going to be created, it's going to be worked as an exchange designated limit order, not a market order. And theoretically, that order will fill. If it doesn't, if it gaps down around it, that order may get rejected or not filled at all, which is, if that's the case, probably okay. So I'm going to make that a 42.18 stop to get into the trade, sell stop, because we're selling this contract to begin with. I'm going to create a buy order to get out if this goes down to 42.02. So we're going to say buy this if it gets down to at a limit price of 42.02. So I'm going to change that next line to my limit price, 42.02. And we're going to make that good till canceled. And then the next level is going to be this stop order, basically the order to get out of the trade if it goes against us, which is the one that we got triggered out of before. And that is now, we set at 42 or 42.31. So I'm going to make this a stop. This is now a buy stop, 42.31. And remember, a buy stop, just like a sell stop, that has a market order attached to it. Once that creates that marketable order, that's going to get worked as an exchange designated limit order. So those fill characteristics are going to be the same as a sell stop. This is just a buy stop because we're going short the contract to begin the trade. We're going to make that good till canceled again. And I'm going to click on confirm and send. I'm going to read through this order to make sure that this is what I want to do. So I want to, if the price of the instrument goes to 42.18, sell that contract. And then buy it back if it goes all the way down to 42.02, down to that level of support. Buy it back at a limit price. Or buy it back at 42.31 if it goes up against me. And you can see what my buying power impact is, or my margin, my initial margin in this trade is. So I'm going to put this in my group, in my futures group, and we'll click on send, and we'll fire that order off. And that order is going to sit there and wait until one of those conditions, that condition to get into the trade, is potentially met. No guarantee of that potential. There's no guarantee that this is going to go to the downside now at this point. All right, so let's come back and let's also take a look at a couple of other areas that are moving. /HG, the copper market was kind of moving this morning. So one of the things that I've been paying attention to and watching over the last little while are these copper futures in relationship to kind of that broader AI trade, because that build out of AI data centers is requiring lots and lots of copper. You've seen companies like FCX, Freeport-McMoRan, and others really starting to kind of move higher based on the current demand for copper. But that's kind of gone back and forth, at least recently here. So we've got a little bit of a kind of double bottom here almost off of this support level in this copper contract. Now we're going to look at the copper contract here in just a second. Let me address JD's question here, which is how long does the good till canceled stay active? So in the Thinkorswim platform, that good till canceled order is going to stay active for this length of time. It's going to stay active until it gets filled, until you, the trader, cancels it, or 6 months, I believe, is the current duration on those good till canceled orders. In which case, if that good till canceled order has not filled in 6 months, or is far away from where the price of the instrument is, probably a good time at that point to reevaluate putting that order in and adjusting that order. So it's not out into perpetuity. There is a finite time span in that particular case. And does a working order eventually expire if it never gets filled? So if we've got that working order out there that's at a day order. So remember, we placed this order. If we go back to that monitor tab, we placed that order. That's sitting there as a day order. So if this doesn't fill over the course of today, it's not going to fill. All right. So let's do this. Let's go back to that chart real quick. This is the /HG. If we do the drop down here and we go down to the futures contracts, we come down here and we take a look at the MHG. That's the micro copper futures. And if we pop over here to the right-hand side, or excuse me, the left-hand side, we maximize that. We can see the tick size, 0.0005. So the significant digit here is this one right there, that 0. The tick value is 1.25. The point value is 2,500 on the micro contract, which means that our notional value, point value times this, 5.3255, that notional value here is that calculation. Point value times the price gives us our notional value of the contract. Now you'll notice that number right there, that significant digit, our tick value, our tick size is 0.0005, not 0.0001. So you're going to see that number changing by increments of 5. It's going to go 505050. And that's because of that tick size increment that we see that change. All right. So that's where this label can be very helpful. As a matter of fact, that label, which is right here, I will share that with you again as I typically do, but it is also for those of you that are watching the recorded version. It is in the description page for this webcast. Anytime we share anything that is for illustrative and educational purposes only, it is not guaranteed as to time or accuracy, but it's a helpful label to put on a chart when you're trading futures so that you can keep track of the tick size, tick value, point value, and notional value of the contract. And it's important to help us to understand that. But now as I'm watching this futures contract and we pop over here to the right-hand side, starting to see maybe this little bit of a double bottom here. So my thought is, my overall perspective in this futures contract is in copper is still a long bias, and that long bias to the upside here above that 5.47 mark. So what I'm looking at is the potential of getting into this trade on a break, on evidence of a break above this 5.38 mark that I've drawn that line. And if it goes to the downside, then maybe we reevaluate this, because if it breaks but down below this double bottom scenario here, even though it's got some negative momentum, look at what momentum is doing here on the MACD, starting to move a little bit higher, and breaking through that level would give perhaps a little bit of evidence that maybe it's bouncing up off of this double bottom. Remember, these are 5-minute charts. So I'm going to look at putting in an order here, much like we did with gold, but in the opposite direction. So right click, and we're going to buy custom with OCO bracket. And we'll just go through it. I think this is a good exercise in order entry. And then we're going to get to those calendar spreads that we talked about. So I'm going to look at entering this trade if copper breaks above the 5.37 mark. So that's going to be a buy limit. And if I were to leave it as a buy limit, that's just going to fill now, theoretically, because that limit order says or better. And when we're buying something, or better is less. So I'm going to change that to a buy stop. Same thing. It's going to create a market order, which is then going to get worked as an exchange designated limit order. So I want to get into that as a buy stop at 5.3785. And I'm going to leave that as a day order. It may not fill. If we were doing this on a longer term basis, we may leave that as a good till canceled, but it's a good idea then always to make sure that you come back and you review that if it doesn't fill within the first day that you think it's going to fill. Because the tendency then is to leave that alone and kind of keep, forget about it. And then you end up having an order fill that you weren't remembering that you had in place. So that's why my habit, and again, not a recommendation, just simply my explanation for this, is to leave that as a day order. And if it doesn't fill within that day, it's gone. And then I've got to come back and reevaluate it anyway. But now I'm going to look at this from that standpoint. I'm going to say, look, I'm going to create this as a stop. And I'm going to create my stop down here, that sell stop, at this level at 531 even. So we're going to go down here to 531. 5.31 even, and we're going to make that a stop, and we're going to make that good till canceled. Now we've got to put an order in here. Since we did this as an OCO bracket, not a buy custom with stop, the potential is to maybe use a target to the upside. So that's where I'm going to kind of switch back over to this previous chart, to the longer term chart, and say, I'm going to set my target, in this case, up around that 5.98, that previous high, and seeing if this will move back up to that 5.98 previous high. So this is going to be a sell limit, sell at that price or better, 5.98. And I'm going to make that a good till canceled as well. So now I've got my target for this to go up. I've got my stop for this to move to the downside. And I've got my entry price and my expectation here. And I'm going to go ahead and we'll flip back over here. We're not there yet, and it's very likely that this is just going to wait, but it's there in the case that that copper price does pop back to the upside. So I'm going to click on confirm and send, read through this order, make sure that that's what I want it to do, noting my buying power impact or my initial margin in this trade. And I'm going to put this in my futures group, and we'll click on send, and we'll fire that order off. So Momo asks a question, do I have a video where I go over futures like my index classes? There are some. Let me show you where those resources. Let me show you where those resources are in this particular case. And I'm just going to pop over here to the schwab.com/futures location. And this is where you're going to find not only content about introduction to futures, start learning about futures, futures contracts, futures margin, futures markets, the various different futures markets that are available, and then some additional information. So this is a great place to get started. Now, JD says, why did I choose the March expiration? Let's pop back over here really quick. By the way, while I'm thinking about it, and there we go, there's a candle that's moving to the upside. While I'm thinking about this, good opportunity for you to follow me, follow Mike on X. I'm at Ben Watson CS. Mike is at Mike Fairborn CS. We'd love to have you follow us over there on X. We're also on LinkedIn. You can follow us on LinkedIn. Make sure that you follow us on the Trader Talks channel on webcast on YouTube as well. But let's talk about the trading tab here. So in this particular case, we've got 10 days to go until expiration. When we put that trade on, let's go to our monitor tab here. And this is the H contract. So here's the thing. This is the most active contract at the moment, but this is also kind of in the middle of that roll. Whoops, that's ES. Hang on, /MHG. There we go. Now we're on the right one. So here's the one that we were looking at. The active contract is the March contract. So these contracts still have a little bit of time. The January and February expirations have a little bit of time left on them. But the most active trading is occurring in that March contract. And so the Thinkorswim platform is going to default when you place an order to the most active contract. So I think maybe, again, this brings up, and brings up perhaps kind of the genesis of this next idea, which is that there are differing time frames and differing forces at work. So we go over here to this longer term chart, and we can see that, we've got some bullish pressure in copper, but at the same time, there might be seasonality. There's not so much seasonality necessarily in copper as there is kind of those supply and demand characteristics. But if you were to look at something like / let's do this. Let's do / ES. And this is the S&P 500 E-mini contract. There is a little bit of seasonality, and I know Mike Fairborn's talked quite a bit about seasonality in a variety of different products, but there's also kind of this expectation that there are going to be times when this market is moving down and when this market is moving up. And if we were to look at that, one of the things that we could do is we could go to the trade tab, and we could look at, let me close that option chain. We could look at this product depth chart for futures and kind of see what that forward expectation is for those various delivery dates. So this is the current active contract. And then the next contract out, there's an expectation that that price is going to go up. And the September expiration, there's an expectation that that price is going to go up. And then the December expiration in 26, there's an expectation that that price is going to go up. Each one of those contracts is priced a little bit higher. But then you get out to this contract, which is March 27, which is not showing on there. We got to scroll down a little bit, and that price comes back in a little bit. And so we've talked before about contango and backwardation. Sometimes you will see this curve go the opposite direction. Sometimes you will see this curve priced this way. And oftentimes this will happen in gasoline, where that curve prices like this, where further out in time, those contracts are getting cheaper or are priced less expensively. Now, here's the question and the context about this is, all right, if we have an expectation that price is going to increase over time, that's the general expectation for something like the ES. There are also periods of time where that price might go down. And we can take advantage of the difference between those expectations in the different contracts. So here's what I'm going to talk about here in this context. If there's an expectation that maybe after the first of the year, the price of the ES goes down after the Santa Claus rally, whatever, we could short the futures contract. But we've still got an overall long expectation about the ES, that we expect that the price of the ES is going to go up. So we could create the relationship between those two futures contracts. One we expect to go down, the other one we expect to go up. Now, that seems to be at counter purposes, but it's not really. We're trading the difference between those contract prices. And what we really want to do is trade whether that difference is getting bigger or smaller. So this is where we're going to get kind of that idea of trading a market outlook about whether we think that the difference between the short-term contract and the long-term contract is going to increase or decrease. So what I'm going to do, let's come over here to our charts for just a minute. And I want to talk about using this chart in a particular way. We've done this before. Remember, we've done the crack spread before. We've looked at this heating oil, crude oil crack spread. This heating oil, crude oil crack spread, this one that we've calculated here, is 42 times the heating oil contract minus a crude oil contract. That crack spread gives us the relationship between one equivalent heating oil and one crude oil contract, right? So it's 42 contracts, so we're putting them in common terms, common denominators. 42 gallons in a barrel of heating oil, and this is a one-to-one crack spread. So this is the relationship between those. When this relationship, and you can see what this is, when that relationship is going up, when that number on the right-hand side is getting larger, going up that y-axis, the spread is widening. When this number is getting smaller, when the line is going down, that relationship is getting narrower or flatter. Those are the terms that typically options or futures counter spread traders will use. Widening or narrowing the spread. Steepening or flattening is also another term that is used. So let's use this idea and let's build. I'm going to keep it as a line chart. But what we're going to do is we're going to build a chart here that's going to show the difference between our expectations. So here, let's come back to our expectation. Let's say we think that the March contract is going to go down, that the March futures for the ES is going to go down in price. So ESH26 is going to go down in price. And we think that the futures contract for the September expiration is going to go up in price. So here's what we're going to do. We're going to take the ESU and we're going to subtract from it the ESH. So let's go back to our chart. /ESU 26. That's our September expiration. And we're going to put a minus sign and we're going to subtract from that /ESU. I'm sorry, ESH 26. And now we've got that relationship. The chart that's on the screen right now is showing the relationship between that longer term contract minus the shorter term contract. And if we have an expectation that this spread is going to continue to widen and go up, meaning the longer term contract is going to expand in price, the shorter term contract is going to go down, we're going to buy the longer term contract, we're going to sell the shorter term contract. If we had an expectation that it was going to go the other direction, we would sell the longer term contract and we would buy the shorter term contract and we would flip that pair around. Okay? So notice the width of the spread here. This is the width of the spread between the ES contract that delivers in March versus the ES contract that delivers in September. So what we're trading, if we trade this, isn't necessarily the overall trend direction of the ES. It is the difference between these two contracts. Okay? That is the difference between these two contracts. So we can build this, and then what I like to do if I'm going to trade this pair is I'm going to save this as a grid, and I'm going to call this not the crack spread, but I'm going to save this as my, we'll call this the March, September ES spread. And save that so that I can come back and I can plot that and watch that over time. Now, how do we trade it? Let's talk a little bit about this. Now, I don't by any means expect that we're going to get into all of the characteristics and details of trading futures calendar spreads in this first discussion today. But I wanted to at least broach the subject and start talking about it. So let's talk about this. Let's go over here to the trade tab. Now, remember, if we look at the margin requirement for the ES, our initial margin requirement is $23,064 in that ES contract. That's to initiate the position. So what I'm going to do in order to make this maybe a little bit more manageable in terms of size is I'm going to come down here to the MES, and we're going to do exactly the same thing. But now our initial margin requirement is a tenth of that. It's 2,306. It's a tenth of the big contract because the micro is a tenth of the contract. All right. So here's what we're going to do. We're going to use the /MES instead of the ES. And we come down here, we close our option chain, we look at that product depth, and we can see the same kind of curve, although not quite exactly the same curve because these are their own products. And that's an important distinction. The MES is its own product separate from the ES. So what we're going to do, if we were going to create a trade here, and I actually did this a little bit earlier, is come over here to our contract, and we're going to sell the MESH, and we're going to buy the MESU. Remember, long the longer dated contract, short the shorter dated contract, and we want to take advantage of that widening spread. The difference between those two prices moving higher or lower. So to create this trade, unfortunately, there's not really an easy way to do this. Not a one-step process to do this. But what we're going to do is we're going to determine which one we want to go long. And I like to do the long first. So we're going to go to the September, and I'm going to just left click on the ask price because we're going long in that contract. Now, what I'm going to do in order to initiate this as an order that accommodates both of these positions, both long this September expiration and short the March expiration, is I'm going to change this order type to I'm going to change this order type to blast all. And the reason I'm going to take this as blast all is because I want to be able to do two legs in this trade. Now, I'm going to hold my control key down, and I'm going to come back over here to the March contract, and I'm going to left click on the bid price for the March contract because we're selling that one. And now you can see what I have. I am short, or I'm going to create a short position in the MESH and create a long position in the MESU. Now, here's the challenge. One or both of these orders might not fill. And it might fill at a different time than the other order. So there is execution risk in putting a spread on like this, a calendar spread. Same thing with exiting the position. But think about this. If there is a concern about the market moving in an overall direction, yes, these are separate instruments and they are going to trade different from one another because of circumstances. But overall trend direction for these contracts is generally going to follow the trend direction, meaning this, that if the price of the instrument or the price of the S&P 500 starts to go down, the short contract is going to benefit from that. The long contract is going to get hurt. If the S&P 500 goes up, the long contract is going to benefit, but the short contract is going to get hurt. So the benefit of doing this is if one side that we've picked directionally or the other works to a greater degree, then we're profiting on that widening of the spread or the narrowing of the spread. In this particular case, profiting from the widening of the spread. We're going to go ahead and do this. I'm going to click on confirm and send, read through this order, and you see that that buying power effect is still the same as one leg of this contract. Remember, that was our initial margin. Now we're going to go ahead and we're going to click on, I'm going to put this in a different group. I'm going to put this in my temporary group so that we're not mistaking the two of them, the one that I already put on. And you watch. So those sold and bought very quickly with one another. The ones that I put on earlier this morning did not. There was a bit of time in between one order filling and the other order filling, and it's in that execution risk that there is a potential for a possible challenge here. So now here we go. here's my contracts right here. And you notice my buying power effect. I want to talk about this for just a second. Okay, I want to go into this for a second. I want to click on this buying power effect right here, and I want to bring up this explanation of that buying power effect. So this is how the Thinkorswim platform calculates that the extreme risk. And this is a deeper subject than we have the opportunity to talk about today. We will talk more about this. But you can see highlighted that maximum up and down. Now, could both go against you? Yes. It's important to remember that. But in terms of this buying power impact, calculating the extremes, this is what the risk calculation comes up with. It's proprietary risk calculation, but it is similar to what the futures exchanges use in determining what that margin or buying power impact might be. We will get deeper into that particular discussion, okay? So as we get into this process, here's what we've done today. We've talked about this relationship between different dated contracts. We've talked about buying and selling that relationship, creating a calendar spread, essentially. Now, here is your responsibility, or the responsibility of a trader in this discussion. Monitor this position and monitor this relationship when you have a trade on. Do not, and I don't say absolutes a lot, but do not let this languish without watching this spread and watching the relationship of those two contracts, because that spread can get away from you quickly. All right, so I'm going to share this one with you really quickly. Again, this is an example, but I'm just going to share this grid really quickly. We saved that as our March-September ES spread. I'm going to share this just so that you see how this is built. And again, this is for illustrative and educational purposes only. And it is not guaranteed as to time or accuracy, and I will put that also in the description of this particular webcast. So let's come back over here to our monitor tab, and let's see what our gold contract is doing. We have not yet filled that gold contract. Our copper contract has not yet filled either, so we're just waiting. We're waiting to see what happens. Guys, we will talk more about this next week as well, and we'll continue this topic. So I appreciate you being with us and joining us for this discussion. Again, if you want to find more information about trading futures, go to the futures section at schwab.com. But you can also come over here to Trader Talks and you can type in futures. And you can see all of the webcasts that talk about those futures contracts right here. All right, guys. Thank you very much. My thanks to Michael Fairborn for helping out with this in this discussion as well today. My thanks to Mindy and our reviewers and everybody else that helped to bring this webcast to you. Have a great day, everybody. We'll see you soon. Take care, everybody. Bye-bye.